Good morning, ladies and gentlemen, and welcome to the SAIE Financial Services Chapter webinar on securing your future through estate planning and retirement strategies. Before we start, a few webinar considerations. Attendees are reminded to ensure the volume is turned up on your device. Ensure you have a stable internet connection. This will ensure the streaming and audio will run smoothly. Attendees can ask questions via the questions panel located within the GoToWebinar control panel, and by default, it is located on the right-hand side of your screen. The chat function is reserved for webinar organizers and panelists to communicate with attendees. Attendees will not be able to chat with each other, however, are encouraged to post your questions in the questions box. A recording of this webinar will be made available on the SAIE YouTube channel. You will find the registration link in the chat box. Please register, it's free. A certificate of attendance will be issued a few days after this webinar. I'd like to introduce you now to our host today, is Prof. Pat Naidu, who is the chairman of the Financial Services Chapter, and he holds the position of visiting scholar in the Department of Mechanical Engineering Science and Professor of Practice in the Faculty of Engineering and the Built Environment at the University of Johannesburg. He is a registered professional engineer and a specialist consultant in electrical engineering, electrical energy, and power systems. He's a fellow and a past president of the South African Institute of Electrical Engineers, a fellow of the South African Academy of Engineers, a senior member of IEEE USA, and a member of IET and CGRE France. Over to you, Prof. Naidu.
Thank you, Minx. Good morning, and thank you, colleagues. Thank you for joining us this morning in a conversation whereby we want to firstly say thank you to Old Mutual for their corporate partnership in providing a value proposition for our membership. We're about 6,000 members, and we've said to our colleagues from the leadership of SAIE, during our busy careers, we always forget to take care of ourselves. So we're trying to assist and support our membership in terms of also taking care of themselves as they take care of their corporates, their customers, and their entities wherever they are working. So today we welcome you to a conversation which will be led by our colleague, Mishek Mdladla from Old Mutual, who will bring on board Old Mutual specialists to guide us in terms of estate planning and our future financial prosperity. Let me hand over to Mishek, and then we'll continue from there. Colleagues, let me remind you that the What Now June issue is available in the handout. You may download the What Now June issue during the webinar broadcast. Also, the webinar will be posting a QR code. You are welcome to also download the QR code and follow through in terms of the processes. Over to Mishek. Thank you, Mishek, and welcome, colleagues. Thank you.
Good morning, colleagues. Good morning, partners, and everybody else who has joined us in this wonderful webinar. Today is the second webinar that we are presenting from Old Mutual in partnership with SAIE. Our partnership with SAIE is to empower and educate corporate members, including their employees. And this is a flight whereby I will be your pilot, taking you through this flight with financial turbulences to ensure that you are going to land safely at your financial independence station or port. Today, there are two important issues that are going to be addressed. It's the retirement planning and the estate planning. And now I'm going to introduce you to Tian Hesselman. Tian Hesselman is Head of Advice and Propositions at Old Mutual Wealth. Tian holds a BCom degree in financial planning, cum laude, a postgraduate diploma in financial planning, and an advanced postgraduate diploma in estate planning. He also recently completed his MBA at the University of Johannesburg. He is a certified financial planner. He has spent the past 14 years in the financial services industry, during which he began his career as a financial planner before transitioning into financial planning, fintech, and the investment landscape He possesses a strong passion for financial planning, estate planning, and the field of artificial intelligence. Ladies and gentlemen, there is a QR code at the bottom. Over to you, Tian.
Good morning, everybody. I hope you're all doing well and that you're warm wherever you are. I find myself in Limpopo this morning. I'm about to go to another client event soon after this, but let me share my screen. And today I'm going to be talking about financial planning and how we look at financial planning at Old Mutual Wealth and also Old Mutual and the broader group. Let me share my screen with you and take you through the exciting, well, I hope it's exciting content that I will be taking you through. I've called this retirement planning and taxation, and in the next 20 minutes, I'm going to take you through some of the things we look at when putting together financial plans with your financial planner. Now, any financial plan, whether you have 100 Rand or 100 million or even R1 billion, can be broken down into just 4 numbers. And these 4 numbers are the same for me or anybody else. The first number is what's the assets that you have available. This could be your pension funds, investments, properties, businesses. The second number is what kind of a lifestyle do you want this particular asset base to sustain? Is it an income you want? Is it holidays? Is it vehicles? Is it maybe traveling abroad? The third number in your financial plan is what kind of a return can you expect on this asset base? And that gets you to the fourth number, well, how long can the money last? Now, you can think of each one of these numbers as a button in your financial plan, and we can work out any one of the 4 numbers as long as we know what the other 3 are. So if I knew somebody had maybe 10 million Rand, they wanted an income of 50,000 Rand a month, that'd be the lifestyle, assume they could get a return of 10%, we could then work out how long the money could last. Now, important part in this assets button when saving for retirement is where you actually end up saving into. What's the vehicle or the mechanism that you save into? Because every single investment in our world differs based on what you go into. So we have retirement funds. These are your retirement annuities, pension, provident funds, preservation funds. And then we have some non-retirement funds, or we refer to them as liquid investments. These can be unit trusts, ETFs, share portfolios, endowments, or sometimes we refer to them as life-wrapped investments, cash savings accounts, fixed bonds, or tax-free investments. Now, when you distinguish between these 2 types of investments, retirement funds and non-retirement funds, there's basically 3 things you look at when deciding on which one is the most applicable. The first one is access. So can you withdraw the money when you want to? This is how we distinguish between retirement and non-retirement funds. The second one is tax. How is the money taxed both pre and post-retirement? And the third one is what can you actually invest the money into? Can you go 100% into growth assets such as equities where you own companies, or are you limited? And that's how we distinguish between retirement funds and non-retirement funds. And I thought I would just show you how these actually differ, and I'm happy to share the slides just for your benefit. Now, when you look at your retirement funds, if you have a pension fund maybe at work, or you have your own retirement annuity, there's no tax on the growth. So any interest that you get or dividends or capital gains, there's absolutely no tax on that, which is a great thing while you are still accumulating wealth. The other thing to keep in mind, though, is that when you get to retirement, every 1 Rand you draw is normally taxed as income tax in the same way as your current salary. So when you draw an income from retirement funds, in most cases, it's taxable. But when you get to retirement, if you have a pension fund or maybe a provident fund or even a preservation fund, you can usually access up to 1/3 in cash. So if I have a pension fund, and when I get to retirement, that is worth 3 million, 1/3 of that is R1 million. And in most cases, the first 550,000 will be tax-free, and the rest will be taxed from anywhere from 18 to 36%. So when you get to retirement, you can access up to 1/3. However, there is a big little star there. In some cases, you can access more. But if you've withdrawn a lot of your money from the 2-pot system, it means that 1/3 that you have available will be less. Now, you can't get that money before the age of 55, unless in this point in time, sorry, let me just take myself off the screen, unless at that point in time that you are actually dismissed or you leave your employer. And then the one thing about retirement funds is there are actually limits from the government. It's called Regulation 28, which actually stipulates how much you can invest into growth assets such as equity. So as an example, you can't have more than 45% invested directly offshore. Then in your liquid investments, it's a little bit different. So retirement funds, very tax efficient before retirement. There's no tax on any growth. There's limitations on what you can invest, but then when you get to retirement, a bit less tax efficient. If you look at your liquid investments, here you do get taxed continuously on interest, dividends, and capital gains, except for tax-free savings accounts, whereby all the growth is tax-free. It's much more tax efficient in retirement when you get to retirement, but there's no tax deductions before retirement. And maybe just one thing to mention on the retirement funds also is every R1 that you contribute to a retirement fund up to certain limits normally qualifies for a tax deduction. So what that means is if I'm earning 50,000 Rand a month and I contribute 10,000 Rand to my pension fund, I would only be taxed on 40,000 if the 10% qualifies for a tax deduction. Now, another thing about discretionary funds is they're much more flexible and they give you much more access to capital when you need it, except for certain investments like endowments. But in most cases, if you have a unit trust, a tax-free savings account, some kind of share portfolio, it's very liquid compared to retirement funds where there's certain limitations as to what you can access. And then the other benefit in liquid investments, even though they're not as tax efficient pre-retirement, you don't get any tax deductions, but there are no limits on what you can invest into. So you can put 100% offshore, 100% into share, whatever your heart might desire, whatever aligns to your financial plan. And then I thought I'd give you, so now we've discussed the two different types of investments you can go into, which is broadly speaking, this is very broadly speaking, retirement funds versus liquid investments. I thought I'd give you an example as to why this is very important when you look at this. Now, with your financial planner who's on the line with us, if you were to come to us for financial planning advice, the way we look at a financial plan is looking at those four numbers. So I thought I'd give you an example of a plan we recently did for a client. So here we have somebody, and I've said they're about to retire at 62. They had some investments, and again, your numbers might be completely different, but the fundamentals could hold the same. They had a pension fund, they saved quite nicely, they had a big retirement annuity, they had a unit trust, and they had two properties, a primary and a holiday home. And they had no debt in retirement. And this particular person wanted after tax in their pocket 40,000 Rand a month, going up with 5% every single year. They also wanted holidays every year, 50,000, and they also wanted to have some vehicles in retirement of 400,000. Now, when we looked at their financial plan, we assumed they would get a return of a very conservative return of 7.5%. And the one thing we saw here on this financial plan was this graph of their capital, the blue graph, and these little dots being all of their capital goals, the vehicles, the holidays. There was a lot of red. And the red showed us something behind the scenes, which is something often overlooked in financial planning. That is liquidity. Now, liquidity just refers to whether or not I have access to my money to fund my goals in retirement. It's something very often overlooked in financial planning. We spend a lot of time looking at markets and what's happening across the globe, but we often don't look at liquidity. So when we delved into this person or this person's financial plan, we saw that they had the bulk of their money in retirement funds, this dark blue pot here, and there was very little in liquid investments that you could easily access. This little light blue shade over there. If you remove this dark blue shade, you'll see that this little light blue shade, there's very little in liquid investments. And these liquid investments were quickly being depleted. And the reason for that was that this client did what most people did. When they got to retirement, they didn't take anything more than the 550,000 tax-free from their retirement funds because they didn't want to pay any additional tax. And they also drew the minimum amount from their retirement funds because, as I said, every R1 you draw from there is fully taxable. So what that meant is the 2.5% that they were drawing, the minimum you have to draw from your retirement funds in retirement, that was now leading to them depleting their liquid capital in retirement, which meant that here past the age of 63, 64, they had no more liquid capital in their financial plan, which meant that these capital goals they had, you see here these big vehicle purchases, the holidays, they couldn't be funded anymore because they had no liquid capital. Their retirement fund had an impact on their retirement fund as well, because now what happened was there's the 2.5% income they were drawing. There's the expenses we wanted to fund for them. That's the 40,000 Rand a month plus the tax they were paying. And now because there's no more liquid capital, we have to increase the money we draw from their retirement money. The problem with that is when you increase the amount you draw from your retirement funds, your expense figure in retirement goes up. And you might wonder, well, why is that happening? The reason that's actually happening is because you end up paying more tax on the income you draw. So now you can see they can sustain the 40,000 Rand a year every year, and it goes up with inflation every year, all the way here up until age 78, 79, where they've reached the maximum limit that you can draw from your retirement funds, which is 7.5%. So this person who saved their entire life, if you had to break down their financial plan into just 4 numbers, because like I mentioned, any financial plan can be broken down into just 4 numbers, it looks something as follows. We knew what the assets were that they had. We knew the lifestyle that they wanted. That's the second number, the 40,000 Rand a month. They wanted 50,000 for holidays, and they wanted 3 vehicles in retirement. We made an assumption on a conservative return. We assumed inflation plus 2 to 3. Now, in simple terms, that just means 7.5% return if we assume inflation is 5. And that got their plan lasting till age 64. Then we said, well, there's only 4 numbers in their financial plan. Which one of the numbers should we be toggling with firstly over here? So what we did was we went to their financial plan and we said, okay, well, let's see what would happen every time we toggle one of the 4 numbers. And I'm basically summarizing the cash flow planning we did for them for you here on my screen. The first thing is we said, well, let's toggle the number that most people are concerned about. Most people are concerned about their investments not growing fast enough, maybe not being invested aggressively enough. So we said, what would happen if you achieved a higher return? Not inflation plus 2 to 3 or 7.5%. What if you targeted a higher return, maybe 9 to 10%? We did that, and that got their plan. They could sustain their expenses up until age still 64, and that 40,000 Rand they could sustain. So the 40,000 Rand a month, they could sustain that till 78, but they still didn't have any money past age 64, any liquid capital for these vehicle purchases and for the holidays. So then we did something else. We said, well, what if we could, once they get to retirement, we don't just draw the 500,000 that you can draw tax-free from your retirement funds. What if we took a full 1/3? Now, most people wouldn't do that because in doing that, you're paying a bit more tax. But what that did was it gave us more liquid capital. And we also drew a little bit more from their retirement funds, which again is not as tax efficient initially, but it gives you the chance to grow your liquid capital. And that got their plan all the way till age 83. So what I'm trying to illustrate here is that we're talking about retirement and tax efficiency. It's very important that you look at having liquid capital and retirement funds pre-retirement, but when you get to retirement, it's extremely important that you partner with your financial planner to make sure you set up these investments correct so that you have enough in liquid money. You decide how much do you commute. It's a very fancy word from saying how much do we move from retirement funds to liquid investments, but also how much do we draw from your retirement funds. We refer to that as a living annuity post-retirement to make sure you don't deplete that liquid capital. That got us to age 83. Now, we really wanted to build a plan that got the client to age 95. So we said, what would happen if you retired later? So we moved the retirement age from 60 to 62. That got the plan here, the 4th number, to age 88. We then said, well, what would happen if you took that holiday home, which is part of your properties here? That's the asset number over here. What happens if we were to sell one of the holiday homes or the holiday home? That got us to age 110. So just recap. The first number we toggled in the 4 numbers was a return. That didn't make much of a difference. The second number was the assets number, whereby we moved some money from retirement funds to liquid money. That got us to age 83. We then toggled the lifestyle number. What if you were to retire 2 years later? That got us to age 88. And then we then sold the holiday home, which got us back to age 110. Then the client said, well, what if I didn't want to sell my holiday home? What if I rented it out? And we assumed on the property that I mentioned earlier, they got a rental of 15,000 Rand a month. That got them to age 95. So in their case, it actually made more sense to sell the home than to actually rent it out. Now, again, in your financial plan, that might be different. It might be based on the assumptions in your financial plan on the rental, what the property is valued, etc., etc. So we went back to sell the holiday home, age 110. And then we did something that most people don't plan for in retirement, we see quite often, which is we added medical aid at inflation plus 4%. So we took 40,000 Rand of their expenses. We kept it at 40,000, going up at 5%, but we added medical aid at 5,000 Rand a month, going up at 9%. And that took their plan back by 13 years, 110 to age 97. It's something that we see people very often not looking at in retirement, is the impact of medical aid expenditure, but also the impact of frail care. But we thought this was quite a healthy financial plan. Age 97 is quite a good starting point. And then the client said to us, well, now that my plan is going to age 97, I want to increase my holiday expenditure and vehicle expenditure. Now, we were planning for holidays of 50,000 Rand a month. We upped that to 100,000. And then also vehicles, we planned at 400,000. We upped that to 500,000. And that brought the plan back from age 97 to age 91. And then lastly, to get the plan to age 94, 95, we again looked at the assets number here, whereby we introduced not just when going to retirement, we forfeited some of the capital, which is something you can do at Old Mutual, to give us a form of guaranteed income. Now, when you get to retirement, you have two options with your retirement funds. You can either invest the money into the market, and then you decide how much income you want to draw, and whatever is left at the end goes to your beneficiaries. Or the second option that you can look at is you can forfeit some of your retirement funds, give it to the likes of an Old Mutual or an insurer, and we give you a guaranteed income for you and potentially your spouse for the rest of your life. But there's a caveat to that. After a certain period, if you and your spouse pass away, there's no money left for your beneficiaries. So this client said that the most important thing for me was making sure I could sustain my income and maybe putting some money into the market to leave for my beneficiaries. So we did a hybrid option where we put some money into the market, some money gave me guaranteed income, and that got the plan going until age 98. Now, I know that's a lot to take in a very short space of time, but these are just some of the triggers you have available when looking at financial planning, when you put together your financial plan. And this is why we think before you make any decisions on whether you go into a retirement fund and liquid investment, when you go on retirement, when you start planning, you need to understand what your four numbers are and what are the triggers involved with them in your financial plan. And that's something, if I must say so myself, we do very well at Old Mutual Wealth, is we spend quite a bit of time unpacking these four numbers for clients and making sure they know what the impact of their decisions are, not just today, but into the future. But then we get to post-retirement, and this is where I'm going to end off now. Now, we've put together this perfect financial plan. We've assumed a return there of maybe call it 9 or 10%. But what often happens in markets is you don't get a straight line return in retirement. And to show the impact of that, there was a very interesting study done. And I know this is very busy. It looks like a 6-year-old's painting. But what was done here by one of our colleagues, Andrew Davis, is he said, well, let's assume that people go on retirement and we want them to invest in such a way that their money in retirement lasts for 30 years. So he took different retirees, 75 of them, and these are various retirees, some of them retiring at the age or in the 1950s, and some of them retiring in 1994. And what he did was he took 75 retirees and he spaced them out 6 months apart. He said retiree number 1 retires in, I think it's 1957. I'm just trying to get this little pop-up out of my way. Sorry, that you can't see, but I can see. Let me just get that out of my way again here. Give me 2 seconds, sorry. Just want to move that. Okay. So he took these, no, I don't want to leave the webinar. He took these 75 pensioners and one person retired in 1 Jan 1957. The next one retired in 1 June 1957. The next person retired in 1 Jan 1958, June 1958, Jan 1959, and he went all the way up until 1994. So what he did was he asked the question, well, what would happen after 30 years? Now, if you add 30 years to 1994, you get till 2024. If you add 30 years to 1957, you get to 1987. So he looked at retirees asking, would they have got until the end of the 30-year term? He gave them all R1 million, and he said they will draw roughly about 5.7%. Now, to put that into perspective, the national average of people in retirement is about 7% that they're currently drawing. It's not even 5.7. He took that up with inflation and he put them into a diversified portfolio. So some equity, some bonds, some cash, some property to make sure that they're very well diversified. And his goal was to actually understand how different market conditions for the same investor with the same amount of capital, the same income need could actually impact them. And what he found was quite astounding. Out of these 75 people, only 32 of them made it to the end of this 30-year term. So if you look at this dark black line here, all of these little lines you see here is a particular investor that invested their money, same amount of capital, same income, but all the little lines that end up here below the graph never made it to the end of the term. And all these other lines had a lot of capital still left after 30 years. Now, he found that one person, one unlucky soul, even ran out of money here in year number 13. Now, what does that tell us? It tells us that you can have the exact same amount of capital, you can have the exact same income that you're drawing, going up with inflation, and just depending on when you invest, maybe you retire in 2008 before the global financial crisis, maybe you retire in 2020 before the COVID pandemic, and maybe you retire in 2022 in the middle of the interest rate debacle. Depending on when you retire, your outcome could be very different. That's why one of the things that we've been doing at Old Mutual Wealth specifically, and 20% of our retirees' money is invested into funds called stable growth funds, smooth growth funds. What I thought I would just show you to end off here is what these funds do. So here's our absolute smooth fund. What this fund does compared to the market, and the market is red. This is all the balanced funds in the market, all those diversified funds I've been talking about. You can see that they've got a much more bumpier ride. And the last 10 years in our market was quite tough if you invested predominantly in SA, because we've had low GDP, high unemployment, etc., etc. So what we've done is we've built solutions that give you a much smoother ride when compared to what the market will give you, and over 10 years should outperform money market as well. Because the one thing, it's not just about knowing what the four numbers in your plan are, it's also making sure that you go into an investment solution that can help you provide some form of a buffer when there are negative market movements, because as per what I've shown you here, depending on when you retire, your journey could look quite different. So to end off on my side, every financial plan only has four numbers. Make sure you sit with your financial planner to understand what your four numbers are. If what I've said here was very complicated and maybe in a bit too much detail, we are more than happy to take any questions either now or after the fact, or you can set up a coffee chat with one of our financial planners, and you've got one of our great planners here online today. But this is just how we approach financial planning and how we look at these four numbers in unison. So let me just clean my screen there. Thank you very much for your time. Thank you for having me. And I'm happy to take any questions. But if you don't feel like asking the question here, please reach out to us and we can answer any of these questions at any time. Thank you so much.
Thank you, Tian. Thank you. First class. Thank you very much.
Thank you.
Colleagues, we open for questions. Questions to Tian. Tian is going to leave us shortly. He has other commitments for the day. And we will continue with the presentations, but let us start on Tian's portfolio. Dinesh, welcome.
So we just have one question here, Prof, to Tian. I have pension funds and public retirement fund systems become Ponzi schemes, and that is the reason why the retirement age keeps being moving out from 55 to 60 to 65 to delay paying out. I don't know. Well,
I'm happy to answer that question. So first and foremost, absolutely not. Our retirement funds in SA are the best regulated retirement funds in the globe, some of the best regulated retirement funds in the globe. The reason that the number gets moved out in most cases is because of a number I mentioned earlier. A safe drawdown rate for you, in other words, the safe amount of money to draw from your investments is 4%. If you have R1 million, 40,000 Rand income a year would be safe. The average withdrawal we see when people go into retirement is 7%. And that is why the retirement age gets moved on. Furthermore, we've seen in our mutual savings and investment monitor that 57% of people actually have some form of a side hustle because they haven't saved enough. The second reason why I would never say that any of our retirement funds are Ponzi schemes, because I can show you people that have really saved enough and are very thankful for that, is we also do see, though, that 43% of people in our country are part of the sandwich generation, meaning they look after both their parents and their kids. And that's the reason that a lot of people just can't afford to save enough. And the last reason I would say the reason the age is being moved out is because if you don't know what your four numbers are, then how would you know if you're even saving enough? And I think that most people aren't looking at their financial plan well ahead of time. They only get to retirement. And if you haven't saved enough, there's no miracle that we can give you. That is when people actually do go into Ponzi schemes, because they try and get these unrealistic returns. And that's when people end up ruining their retirement funds. But no, I can tell you for sure that we've been around for 180 years as Old Mutual, and if we were a Ponzi scheme, we wouldn't be around for that long.
Yeah. Thank you, Tian. I think that's it from that side. There's no other questions. I think if it's okay, you can be excused.
Yeah,
Let
me,
sorry.
sorry, I got a few more. I got a few more for
Yeah.
Tian.
Yeah.
All right.
Oh.
Thank you, Tian. Tian, is tax-free savings investment a viable option for retirement planning?
So it's one of the best things our government has ever done. The only thing I wish there was more of in a tax-free savings account is the amount you can put in. It's a fantastic option. None of the income you ever draw is taxed. You can go 100% offshore if you wanted to, if you had that kind of risk appetite. You can invest into a wide range of assets. The only thing I don't like, I wish there was more of, is you only can put in 36,000 Rand a year or 500,000 in your lifetime. But in 14 years' time, you should try and maximize that if you possibly can. And I think the best gift you can give your kids, if they're ever born, is to take out a tax-free savings account for them if they don't touch it in the short term, because you get the most amount of benefit over the long term.
Excellent, excellent. Thank you for that, Tian. Tian, the graphs that you showed, are they net of fees, management fees?
Yeah, so the graphs that I showed there was net of management fees. So when I showed you the performance there of our fund compared to the market, that is net of the fund fee, and the fund fee that I showed you there, the absolute smooth fund, is 1.2%. Now that is very competitive, keeping in mind that we don't just give you what the market gives you. We hold back when the market is running a bit. So if the market's doing 15%, we only give you 12. But during periods like 2008, 2020, we give you the surplus that we have built up there. And again, that fund is an all-in fee of 1.2%. Now, to put that in comparison, most balanced funds in the market range at about 1.5 to 1.8%. So it's a very competitive fee. In our perspective, although we are very clear, we don't think should go into the cheapest fund. We think we should go into the fund where you get the most amount of value. Okay. As an example, the best fund in this market in South Africa, there's 1,800 funds. The best fund over 20 years, don't ask us, according to Citywire, was our Old Mutual Global Equity Fund. That fund has a fee of 1.8%. Some people might say that's quite large. That fund has done 14, 15% over a period of 15 to 20 years. Now, again, my argument always is, would you rather pay the lowest amount of fee but then have less return, or are you willing to pay a little bit more for a good asset manager? Yeah.
Excellent, excellent. Tian, in terms of Regulation 28, talk a little bit about that.
Regulation 28 basically limits how much you can invest a retirement fund in different asset classes. So you can't invest more than 45% offshore. You can't have in the region of 70% and more into equities. And the reason that the government did that is specifically as you get to retirement or closer to retirement, they don't want you to risk going into a negative market cycle and reducing a lot of your capital. However, I must be honest, I do think that if you're a bit younger like me, and maybe Dinesh and yourself, Prof, being very young, obviously, you do want access to as much growth assets as possible. So I do think that you probably want to, I would like to see a little bit more relaxation for maybe younger investors. But again, Regulation 28 is there to protect you, specifically heading into retirement, whereby the last 5 years getting to retirement is very crucial. And the first couple of years when you're drawing an income is very important. Remember, when you're not drawing an income, when markets are volatile, it's actually good if you're contributing. Because if the market's down 2 or 3%, you are buying more units. That's what you actually want to do. It's when you start drawing, whereby now, if the market's down 3% and you're drawing an income of 4%, you're actually down 7%. So you need a 7% return to make up for that. And that is why Regulation 28 was fundamentally put into place, is to ensure that because most people don't have enough saved for retirement, they don't have those big movements very close to retirement. Yeah. But I would personally, this is my personal view, I would just like to see a bit more growth assets when you are younger. But again, that's where tax-free savings account is fantastic. Yeah.
Perfect, perfect. And Nolan wants us to share the presentation for all attendees. Would that be possible?
More than happy to share. More than happy to share.
Oh, first class.
Okay.
We'll fix that up. Nolan will get that presentation, and all attendees. We have very good attendance today. Thank you very much. And we will share the presentation with all. Let me take this opportunity to say thank you to Tian, and we release you now, Tian. Thank you to Dinesh, and thank you, Tian. Thank you. We go on to the next presentation, Welcome, Suzelle. Over to you, Minx. Thank you.
Thank you, Prof. Mishak, you'll introduce Ms. Jooste. Just unmute yourself, Mishak.
Thank you, Professor. Thank you, Dinesh. Thank you, Tian, for such a wonderful presentation. Now I'm going to introduce Suzelle Jooste. Suzelle Jooste is our legal advisor manager here at Old Mutual. Suzelle Jooste oversees the management of legal advice in Johannesburg for various distribution channels, including broker distribution, personal financial advice, which is us, and agency franchise distribution. Suzelle has been with Old Mutual for nearly 19 years. Her role involves providing verbal and written legal, technical, and financial advice, no product advice, to brokers, advisors, and clients regarding estate, retirement, and business assurance planning. Additionally, she delivers presentations on these subjects to brokers, advisors, and clients. So please listen to her presentation, and whenever you need to follow up, you just give me a call, and then I'll give you access to her. Over to you, Suzanne.
Thank you very much, Mishak. I really appreciate that. Thank you everyone for the opportunity to speak to you about something that I feel very passionate about, and that is estate planning. So today we're talking about estate planning, and again, also, that living never retires. I just want to also get rid of this little pop-up screen here. Okay, so we asked the question, why estate planning? And the short answer to that is because life happens. We need to look at estate planning, and a lot of people actually look at estate planning when they're going to get married. Then they start to worry about wills, and then maybe when your first child is born. But then life can happen, and there might be a divorce, and that is actually very, very strongly advised or advisable then that you do look at estate planning. What if one of your heirs are insolvent? That would also mean that you would have to look at your own estate planning and then plan, in terms of their inheritance, what will happen to that, because you don't want creditors to actually be able to lay their hands on that. If you are in your own business, your business structure, what will happen if one of you or maybe one of your partners pass away? What will happen in terms of the succession planning in the business? You're all engineers, so it might be that your heirs are not engineers. And what will happen to your business then? Would you be able to make still provision for your spouse to maintain her lifestyle standard after you have passed away? So that is very important to actually look at it and to run through the numbers. So what we do as legal advisors, we're actually there to assist you together with a financial planner like Mishak, to do a proper estate plan, and we do the actual numbers. And we help you to make an informed decision in terms of, saving costs, making sure that it's practical, and all based on the numbers. So it's not a thumb suck. And I must say, ever since I joined the insurance industry, this really made such a difference, because even when you draft your will, you can't just thumb suck, on what would happen without the numbers. So one actually run the numbers, you are able then to see, how much costs are there involved, and then, you make your decision based on that. Okay, so maybe just to take this a little bit further, what if you have offshore assets? Is it advisable to have a separate will for offshore assets or not? What about, we know young children, or my child's now at university, but, let's say they studied and they want to immigrate. How would that change your estate plan? What if you or one of your dependents become disabled? So we have to do estate planning, and we shouldn't leave this until too late. It's very, very important to do this while life actually happens. But let's say nothing funny happens in your life, then at least every second year, I would advise that you actually review your plan and just make sure that you actually do give attention to it. So as Prof. Naidu said, in the end, it's very important that we actually spend time on our own planning, because we're so busy with life and life's issues that we don't actually spend the time on planning. And I always tell clients, the planning that you do now is actually time and a lot of tears that you actually save your loved ones, should you pass away. So therefore, I urge you to actually spend the time, in terms of your estate planning. So what is estate planning? What is it all about? It's actually about preserving, it's about growing, and it's about protecting. It's also to make sure that your wishes are adhered to. So it's not a one-size-fits-all activity. And it's also not a once and for all activity. So like I said, it's not something that you just do for once and then you leave it. It's much easier if you've done it the first time to actually review it. But it's definitely also not a one-size-fits-all, like Tiaan said, in terms of his, the 4 numbers that he spoke about. Very important that one actually look at your specific circumstances, and your family dynamics. Everyone is handed a different package, if I can call it like that. And therefore, it's very important to look at your specific estate planning. So it's not advice that's given around a braaivleis fire, and what's fit for another client is maybe not fit for you. So very important, to then plan according to your specific circumstances. So who should be part of your estate plan? A specific team is normally what we advise. So that would be the estate planner, that's yourself, your spouse. Very important to include your spouse, that there's not a surprise waiting. And Old Mutual had a advertisement years ago that actually said everything starts with a plan. And that's still very, very important to make sure that, both of you actually know what the plan is, what the succession plan is. Your accountant or your auditor, and then very important, your legal advisor or your fiduciary specialist or attorney. And this is where we can come in as legal advisors together with your financial planner to actually hold your hand, test the numbers, look at everything, and together with the rest of your team to make sure that everything is going according to plan and to have a plan in place, first of all. So if we look at estate planning, and if we look at, just the aims of estate planning, I'm just going to touch on a few of those. So the first thing is you actually want efficient deceased estate administration. You want your family to go through this with minimal pain. It's difficult enough as it is. It's much more difficult if things, doesn't work out because you didn't plan. I worked for a very long time at Old Mutual Trust, in the trust or in the estates department. I head up, one of the estates departments. And what I saw was there was a lot of emotions about people, being very upset with a deceased husband or a deceased spouse because they didn't actually have a plan in place. So please, let me urge you, let that not be you. At least make sure that there is a plan in place. Secondly, aim can be to distribute the assets according to the client's wishes. Very important. If you don't have a will in place, then no one's going to know what your wishes are. I once met a very wise financial planner that actually said to clients that if you don't have a plan, then the government's got one for you. And tongue in the cheek, that's just referring to the Interstate Succession Act. So that means if you pass away without a will, there's actually certain rules and regulations that must be followed in terms of who will inherit then from your estate. So make sure that if you want your wishes to be adhered to, that you actually have a valid will in place. Tiaan also referred to liquidity. Liquidity extremely important in your estate to make sure that there is enough cash in the estate. Why? Because there's the executor's fee that needs to be paid. There's maybe properties that needs to be transferred. And all of that costs money. If your estate is higher than the 3.5 million rand, and let's say you're a single person, you don't have a spouse or a life partner, then it means that there is no distribution to a spouse. So therefore, estate duty becomes then applicable, and you have to plan also for estate duty and to make provision, for the liquidity. Otherwise, if there's not liquidity in your estate, then the estate administrator or the executor actually winding up your estate wouldn't have any other choice but to actually sell assets, if your heirs doesn't have money to pay into the estate to pay all the costs, and in order to actually create liquidity. So when we do an estate plan, you will see that one of the things that we do is we actually test liquidity, and we make sure that there's no surprise, for your spouse or for your heirs, to make sure that they know that there is a liquidity shortfall, and we will advise, accordingly, that they make provision for it, or maybe there is a policy payable outside of the estate, and then they must know that, there's a certain amount of that policy that they have to keep out for liquidity purposes. Then to provide for dependents or to protect minor beneficiaries with special needs. And here we just, specifically referring to that because it might be that, this is part of your family dynamics, that there is a special needs child, maybe someone, or Down syndrome child that one will have to look at, for the rest of their life. Is there a specific special trust in place which has got benefits and advantages, tax benefits for that child, and to make sure that you at least have peace of mind that child is taken care of. It might be an elderly parent. It might not be a child with special needs, but it might be an elderly parent, maybe dementia, that there must be provision, for that person in terms of a trust. So that is also something that we can look at and that we can actually advise you on, separately. Then, of course, in every estate plan, we want to try and minimize the impact of taxes on the estate, and that we will show you, and we actually calculate the executor's fees, we calculate the estate duty according to what it is now, and we actually make a proposal, and then it's your decision whether you want to go according to the proposal or not. So you also want to provide for future growth outside the planner's estate. Let's say you do have a trust. We also look at the trust. I can do a trust audit for you in line with legislation to make sure that it actually kept up with legislation. Let's say it didn't, then I will advise you, that there's certain clauses that have to be changed and that one can refer back to your attorney or back to your auditors. I mean, it doesn't cost you a cent. Mutual is actually providing this to you as a client, as a value add, together with a financial planner. And this can actually make sure that you do have, at least peace of mind that everything is according to the law, according to legislation, and that everything is up to date. If you have got business interests, very important, again, coming back to succession planning, what will happen if you pass away? Is there a key person in your company that can actually take over, and that can run with the business if you're no longer around? Or would you rather want to be bought out by your partners on death or disability, and make sure then that there's proper agreements in place for all of that? So in that instance, in terms of the business interests, specifically in the succession planning, we can also assist you. I think we touched already on the unique circumstances for your family that we can look at. Offshore assets, very important to take account of offshore assets, and we normally advise that there should be a separate offshore will. Let me use an example. Let's say you've got property in, let's say, in Portugal, for instance. Very important that, yes, we are taxed on our worldwide assets, as South African residents, but it's important to make sure that your estate in South Africa, is winded up as fast and as quickly as possible. It gives closure to your heirs, but it also helps then in terms of, that the estate and the winding up thereof is not delayed, in the sense of, that they will have to deal with that property in Portugal as well. So therefore we advise that is dealt with separately. So your will in South Africa only to refer to your South African assets, and then according to obviously the jurisdiction and the executor that you appointed here, and then your offshore assets, in the country where you've got that offshore assets. And then obviously you will have your specialists there that will know how the tax work in that country. And the reason why we actually advise that it's dealt with separately is just to make sure that there isn't a delay in terms of the winding up, of the estate. Then one can also touch on, whether you want a living will. Now, a living will in plain, if I can just maybe explain that plainly, that is where you have the decision whether you want to be kept alive if anything happens on machines. And if you don't want to be kept alive on machines, then, there's something called a living will that can be drafted for you to actually make the decision easier for your loved ones to say, but no, Dad didn't want to be kept alive by a machine, so therefore then one can look at a living will. Obviously, we do estate planning to minimize costs, and to look whether we can save on executors' fees. If you have a substantial estate, then one can negotiate an executor's fee, and maybe just we will touch on it later as well. But while you're alive and you're in a strong position, you can actually negotiate an executor's fee with your executor. If you leave it and if your will doesn't mention anything about executor's fees, it means that you're going to pay the standard executor's fee of 3.5 plus VAT. So therefore, executors is not going to change, share with you, and that's what we see, that they don't share that you can actually negotiate the fees up front. So therefore, make sure, and that's part of one of the advice components or comments that we will give in our report, to say that you can actually negotiate an executor's fee with your executor. And then lastly, I think very important, ensure that the plan is practical, that it's legal, and that it's efficient. And that's what we do. We play devil's advocate. We make sure whether it is actually practical or not. So for instance, if you have a farm and the farm is not in a company, you cannot bequeath the farm to more than one person, so in terms of legislation. So therefore, but it's easier if it is in a company, for instance, because then there's shareholding that can be shared. So about the practicality, that's definitely something that we test when we look at, estate planning. Okay, so let's stand still at the last will and testament. In my mind, I think this is one of the most important documents that you will ever sign, in your whole life. That in your antenatal contract, I would think, is most important. It should be reviewed and updated on a regular basis. In my experience, I still find a lot of wills and clients think that the will is valid. And for instance, then the will is not, is not dated. The date is not a requirement for the will to be valid. However, it's very difficult for your family to show which was your last will if it's not dated. So it's very important that the will is actually dated, and that it's signed with your witnesses as well. We strongly advise that you consult with a specialist when you draft a will. You're definitely not, you're professionals. You can't just go to CNA, okay, we don't have CNA anymore, PNA, and then just, draw or get a will and think that that is going to solve, all the problems. I strongly advise that you consult with a specialist when you draft a will to make sure that all your specific and your unique circumstances, are that. We already said that, if you don't have a plan, then the government's got one for you, and that is the interstate succession. So that is where you prevent actually dying without a will. Very important. So please, there's actually, still a lot of people that don't have wills. I don't know if they plan to live forever. But yes, unfortunately, that's something that no one of us know. We're not going to live forever. So make sure that you do have a will in place. If you don't have a will, then it delays the winding up process of the estate, and it is actually very hard then for the family, to deal with everything. If you don't have a will, then the master may also require that the executor will have to provide security, and even that can be very difficult then, for your loved ones. So in short, I think the best advice here that I can give is to make sure that you have a last will and testament. If you want a second opinion on it, then we can look at it. When we do an estate plan, we actually do look at your will, and we look at your trust as well, and make sure that there's not, conflict between the documents, because it's very important to make sure that everything will go according to your wishes. If we look at the Wills Act, maybe just also to update you on the Wills Act. So for the valid execution of the will, and this is extremely important, is a person must be 16 years or older, and you must be mentally capable of appreciating the nature of your act at the time of signing the will. So obviously you have to be 16 years or older, or your child then with assets to have a will. A witness can be 14 years or older, provided that he or she is not incompetent in giving evidence in a court of law. So obviously they must know the difference between right and wrong. What do they witness? They don't have to know what exactly the will contents are. They're just witnessing that it's me, Suzelle, that's actually signing the will. And then the most important requirement is, in terms of the Wills Act, all the witnesses and the testator or the testatrix should be present at the very same time when the will is signed. Just in short, there was a court case years ago. It was a Dr. Robenheimer. And what happened is he signed the will, but there was no witnesses. It was his second marriage. The financial advisor went back to, Cape Town, and he let his secretaries and his PAs in the office sign the will then as witnesses afterwards. The children of Dr. Robenheimer then saw that, these witnesses, they actually did a little bit of research, and they saw that these witnesses, there's no way that these witnesses could have been with their dad, because the witnesses was in Cape Town and Dr. Robenheimer was, in Pretoria. And they actually contested the will. And in the end, they actually won that court case. That wasn't the last will and testament of Dr. Robenheimer. It was an invalid will. Why? Because of the reason that all the witnesses and the testator was not present at the same time. So please, 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 if you just remember one thing from today's presentation, make sure that you and the witnesses are at the same time present when you sign the will. Otherwise, your will is not valid. And you don't want your will to become a court case and all your friends and family then read of you, in the media. Just because of that, validity reason, that you missed out on. If you nominate the executor, important to nominate the executor that actually knows what to do. It's not an easy job to be an executor of an estate. Where a layman is appointed, then the master actually require that there's an attorney or an accountant that will assist with the administration of the estate. We dealt with offshore assets already, where we said that our recommendation is that you actually do have a separate offshore will. The executor is entitled statutory to the following remuneration. So 3.5% of the gross value of the estates, of the estate plus VAT, if the executor is registered for VAT. And then something that people do not know is that the executor is also entitled to 6% on income earned after death. So let's use an example. Let's say I've got a second property and I'm renting that property out. And there is actually tenants in that property when I pass away. So that rental that comes in after I pass away, the executor is then entitled to 6% on the income that is collected after death. So that's not going to be the 3.5% statutory fee. Very important, if you want to negotiate that up front, to actually make it, and to get it written in your will. Let's look at some divorce considerations. Just two things that I want to highlight. Let's say the divorce order makes provision for maintenance of a spouse, or then maintenance for children. There is a pitfall in the sense of, that a lot of people think that if they just nominate the ex-spouse as beneficiary on the life policy to cover the maintenance obligations, then everything should be fine. Let's say as the wife in these circumstances, then just make sure, because if she's the beneficiary on the life policy, she can still actually claim on behalf of the children against your estate. So it's better to rather than have a maintenance trust in terms of your will, and to say then that this is to actually to adhere to the maintenance, in terms of the divorce order. It's very important that divorce orders are drafted correctly in terms of your retirement benefits. So, and that's where, you're not retired yet. your spouse wants to claim against your retirement benefits. What Old Mutual offers is that we actually look at the settlement agreement before it's actually signed as an agreement and before it's actually made an order of court, to make sure, that it actually, crosses all the T's and dot all the I's in terms of the Pension Funds Act and in terms of the Divorce Act. So you are welcome again to contact the financial advisor, and we can actually send your settlement agreement, into head office. We can look at it and then see, whether it actually adheres to the requirements of the Pension Funds Act and the Divorce Act. And I know that it is similar with a lot of the other insurance companies in South Africa as well, where they do have client-facing legal advisors like myself. If we look at domestic partners, just want to touch on domestic partners as well. There is a lot of people that are just staying together these days, not necessarily married. So if we look at a spouse and the definition of spouse, it includes a person who's a partner of such person, and it can be in a same-sex or a heterosexual union, which the Commissioner, and that's referring to the Commissioner of Inland Revenue, is satisfied then that it is intended to be permanent. So it's all got to do with the intention. Is your intention for it to be permanent? One gets couples that are, that are engaged and they stay together and they never actually get married, but their intention is for the relationship to be permanent. So some factors that court might look at, in terms of permanence, they look at partners living together in the same residence, for instance, they share the same address, they share bank accounts, they might be on each other's medical aid, they might be on each other's, life policies, they've got joint ownership of assets, and the time period of the relationship. However, what the media throws at us to say, no, but someone has to be staying together, let's say for 6 months or for 3 months. There's no time period actually on it. The commissioners specifically say that if you want someone to be your spouse, it means that the intention must be there for it to be permanent, and obviously then they will look at all those requirements that I've just been referred to in terms of the circumstances. So each and every case will be looked at separately in terms of the specific circumstances in that. So domestic partners, we await change legislation. So before, domestic partners were not protected in terms of the Interstate Succession Act. That's now where you pass away without a will. It means then that the domestic partner couldn't inherit, necessarily if there wasn't a will in place to actually protect the domestic partner, or claim then maintenance against the estate. But there was a constitutional court case, the Bwanya case, and that case specifically said that it was totally unconstitutional, on those acts, because those acts require that you must have been married. However, both acts now need to include life partners as well, and we await the amended legislation. But the best way is actually to make sure and not to leave anything to chance, but to have a plan in place. So if you want to provide for your partner, being your life partner, the first thing would be to draft a will to make sure that it's valid, to enter into a proper cohabitation agreement. And there are attorneys that actually specialize in that deals with the breakdown of the relationship, almost like a divorce, what will happen then. And then if you want to make provision for each other in terms of a life policy, to make sure that there's a life policy for one another, with that life partner then, being a beneficiary. Just some advantages of policy beneficiary nominations that I want to touch on is some advantage is, let's say I've got a life policy and I nominate my spouse specifically. It means that my beneficiary does not have to wait for my estate to be winded up. And that is a huge, huge benefit. They will have immediate access to liquidity, to money, and everything wouldn't be like the horror stories that we hear, of money that's actually locked up in an estate. So it does make sense to actually look at your beneficiary nominations on policies as well. Just on that, a word of serious caution is do not nominate a minor child on a policy. Why do I say that? Because if you nominate a minor child, the child will will immediately then get the money in a bank account, even although that child might not have a bank account yet. The guardian of the child will have to go and open a bank account then. And it will mean that the guardian of the child, and that can be the ex-spouse, maybe not always, in the best interest of the child, then have access, to the money. So therefore, in the case of a minor child, it's rather recommended then that there is rather a testamentary trust set up for that child, and to make the policy payable to that testamentary trust, to make sure that there are trustees that actually look at that money, and to make sure that it actually is protected, for the child. Another advantage, if you have a policy with a beneficiary nomination on it, so let's say you've got, major children over the age of 18 that can work with money, then one of the benefits is that you save on executors' fees, because it pays directly to that beneficiary, and that means the executor can't charge the 3.5% plus VAT on that policy. Then also, the proceeds of a life policy will not form part of an insolvent deceased estate, and there are a few requirements that have to be met there. But if there's a life policy in place and it existed for 3 years prior to the insolvency, etc., then it means that if that is paid out then to the beneficiaries, then it has to be paid out, and the creditors cannot touch that. So as I say, there is a few requirements that have to be met, but these are just some advantages of having policies in place with beneficiary nominations on that. Okay, I'm nearing the end. So just in terms of the reality check, I want to say, don't be a statistic, plan. Make sure that you do have a plan in place. Make sure that if you have a plan, keep it updated, review it, because it's not just once in a lifetime that you should do estate planning. You should do a plan and then regularly revisit it. Clearly define your wishes. And if you're not sure if something is going to work out, get a second opinion. And if whoever helps you with your plan is not running the numbers, I would strongly, strongly recommend that you rather, check in with us, that we can actually do an actual calculation for you to show you the cost of dying. Yes, there's a lot of costs that's actually hidden in terms of an estate, and then to get a second opinion, just in terms of your planning, and to make sure that it goes according to your plan. And the last point there, to make time for your financial planner. You should at least every year sit with your financial planner, review your plan. And I'm just talking about the estate plan. Tian already touched on the retirement plan. But you should, like you go to your doctor for your health checks, you should actually check your financial health and make time, with your financial planner for your estate planning as well. So just in terms of a call of action, if you want access to myself, or if you are, somewhere else in the country, if you need to see a legal advisor face to face, we have got more than 26 legal advisors countrywide in all the big centres. But I mean, luckily now with MS Teams, like we saw, Tian was in Limpopo and he could call in. So it's very important, or it's easy to also, do this virtually. But you can contact Mishak if you want access to myself, or if you want to run something, past me, or if you want us to do a proper estate plan for you. It's really a bespoke estate plan, making sure that you do have peace of mind. We review your will with you just to make sure that everything is according to plan, and cost you a cent. This is something that Old Mutual offers, for their clients. And maybe just also to give you some further peace of mind, in terms of the FACE Act, all the Old Mutual client-facing legal advisors are registered. So we are registered advice givers, and Old Mutual stands in for the advice that we provide. So it just shows a feather in the cap for us. We client-facing, but we also have to make sure that our CPD points, etc., everything is in place to actually advise you. So that is it from my side. Thank you very much.
First class. Thank you, ma'am. Thank you very much. An excellent presentation. Much appreciated, and most welcome. Thank you. Colleagues, questions? The floor is open. Dinesh, are you going to also help me again? All
Prof. Naidu, I can assist here.
Yes, I see Pascal has got his first question. Please go for it. Are you?
Yes.
Did you pick it up? Go for it.
Pascal, yeah, Pascal Motswasele, who is a past president of the SAIE, is asking, is there a salary bracket for one to qualify for estate planning? And what about an age by which it's too late for one to qualify for estate planning? I'm asking because Suzette says you need a team of professionals, accountants, etc., meaning affordability surely comes into it, doesn't it?
Okay, thank you very much for the question. Yes, a team comes in, definitely, but obviously it's also your choice if you don't want to include some of the ones mentioned. So for instance, I'm thinking about an accountant. I know that engineers are very, very technical. And normally, I mean, I'm just astounded at, just how I get Excel spreadsheets with everything, a budget, everything together. So if you don't, want your auditor or your accountant to be part of the consultation, then it doesn't have to, it doesn't have to be like that. Just on the question, I would say if your estate is, above 3.5 million rand, you should clearly look at it. Obviously, if your estate is smaller, then the estate plan would include, looking at your will, making sure that that is, that is valid and that is practical. So therefore, it can be easier if the estate is smaller. If your estate is above 3.5 million, or let's say you have trust, you've got various, other assets, then of course, then estate planning is part of it. And maybe just on that, yes, the accountants would ask you a fee for that. As I indicated, there's not a fee, to include your legal advisor, and your financial planner is also not asking a fee. So I hope that that gives an indication. So for your smaller estates, you can do it on a cheaper, in a cheaper way, just to look at your will and to look at your policies, and to use a legal advisor, from an insurance company together with your financial advisor. Obviously, if you have, more assets and you're more astute, then, you will include the rest of the team.
Well, thank you, ma'am. Thank you for that. Suzelle, can you talk?
Sorry.
Oh, sorry, Minx, go. Sorry,
No,
Minx.
go ahead, Prof. Naidu. You can take over.
Okay. Now, Suzelle, can you talk a little bit about nominated beneficiaries and thereafter in terms of the will itself and estate and tax planning? How does that all come together?
Okay, so do you mean on policies, Prof?
Yes, on policies. If you've got nominated beneficiaries, say at your work, on your policies at work, on your investments at work, how does that work? Does the beneficiaries receive it without it having to go into their estate? I think that's the question.
Okay, thank you very much. So if we refer to your benefits at work, I understand your pension fund, and you might have group life cover, benefits on your pension fund, and
Correct.
there it's different from your life policy. So I want to differentiate there what happens. So if you have benefits at your work and on your pension fund, that falls under the Pension Funds Act, Section 37C of the Pension Funds Act.
Right.
And what that means is, it means that the trustees of your fund have got a certain discretion. So in terms of the Act, they have a discretion in terms of who's your dependents. They will look at your circumstances. As an example, let's say you have minor children still dependent on you. Obviously, then they will use their discretion to pay out to your beneficiaries. But if we can add on to the example, let's say you also have a mother that is dependent on you, then it means that she can also be taken into consideration, and the discretion of the trustees can be exercised that a portion of your pension fund can also be allocated to her, your spouse then, and let's say your minor children. And just as a word of caution, even if your children are over the age of 18 and they're independent financially, in terms of the definition in the Pension Funds Act, they still qualify as dependents because they are your children. And they will be able to get the benefits, yes, straight, but it will be depending on the trustee's discretion.
Right.
If you have got unapproved benefits at your work, that means it's like a life policy almost that your employer took out,
Right.
you know, separately to your pension fund benefits. Normally there is, you know, a beneficiary option on there as well, and that will pay directly to whoever you nominate. So let's say you've
Perfect.
nominated your spouse, it will pay out directly, and there's no discretion then for the trustees to make, you know, any other calls than the beneficiary that you have nominated. I hope that answered your question.
Very, very clear. Thank you, ma'am. Thank you for that. Thank you, Pascal. Thank you for that good question. We've got Minx, continue. Are you there? Join
Yes, thank you. We've got a question here from Chizakula Kaputu. Where does prenuptial reside in estate planning, and is it legitimate and not contestable?
Okay, so before you actually get married and you choose a marital regime, you know, of how to get married, that is then an antenuptial contract that you know, enter into. So for instance, in South African law, you will enter into an antenuptial contract to get married out of community of property, or then out of community of property with the accrual. And that means basically that whatever the estate grow, you know, after you got married, you know, how you will split that in case of death or in case of divorce, because the accrual is just applicable, you know, on death or on divorce. So that is where it comes in. It's extremely important because when we do planning, one of the questions is actually how you're married. So if you are married in community of property, it means that, you know, every party will then share in the estate 50-50. And therefore we will have, you know, a different calculation method from someone that's married out of community of property, because there everyone will have, you know, their own, you know, their own estate. So obviously out of community of property, you know, each one separate estate. In community of property, it's one estate, but then it's split in half. And there are some, you know, planning, you know, that you have to take into consideration in those circumstances. So when it comes in, is actually, you know, when we do a data gathering for me to understand your picture, or whoever your financial planner then is, or your fiduciary specialist, is that's extremely important, you know, of how you are married. And I can maybe just add for business owners, you know, if you enter into a buy and sell agreement, for instance, you want to sell your shares on death in your business, it's important then that your spouse, if you're married in community of property, to give permission that you can actually do that. Because in terms of legislation, you know, there's certain things that you can't do without the permission, you know, of your spouse. So yes, your marital regime extremely important.
Thank you.
Our last question is from Lucas Anthonison. It says, we have to see the video recording of the webinar. Yes, Lucas, if you can just click on the chat box, there's a link to SAIEE TV on YouTube. Just register and you will receive a notification of once this recording is uploaded later today. Thank you. It seems like that's all the questions we have for now.
Excellent. Thank you, Minx. Thank you, Minx. Thank you, Suzelle. Thank you very much, colleagues. It's been an excellent presentation from Suzelle and Old Mutual. Much appreciated. Let me bring on Mishek to say thank you and share appreciation from his side. Mishek, if you can come on, please. Thank you.
Colleagues and all the partners, thank you very much for having left some of your matters that could have been very important to attend this webinar. I think with my confidence that we have learned a lot about retirement planning, a lot about estate planning, and we have also learned that if you do not take control of your financial matters, someone will take control of your financial matters, and that is the government. And the government won't do according to what you would have the winding of your estate to be done in such a way that you would have wanted it to be done. Retirement planning, it is very important to start very early and to learn that your expenses at the age of 65 will not retire with you when you go on retirement. And with estate planning, living never retires. You are creating a legacy that will work for your family and inheritance to future generations of your family. Suzelle made it very clear that if you are a human being, for your health, you need to meet your doctor every year. For financial planning, you need to meet your financial advisor every year. And for corporate partners, I am here to assist you with your buy and sell agreements that Suzelle mentioned, and also your employees, to give your employees access to financial literacy so that the production or productivity of your employees could improve. Because if employees are not given access to financial education, they will always be under stress for unnecessary reasons, for something that could have been prevented. To the SAIE, thank you for having partnered with Old Mutual to give us this space to educate the nation. Thank you, thank you, thank you, thank you. And then there's a link on the chat box for if the QR code is giving you issues. There is a link on the chat box to click to be able to give feedback. And there are also very important links which have been posted by SAIE, which will add value to your life. And for members, for people that are engineers who are not yet members of SAIE, please don't continue missing out on these valuable aspects. Join SAIE today for you to feel the taste of what others are enjoying. SAIE is a home for every electrical engineer to belong. Don't be out of home. Don't be out of home. Here is the home for you. And the chairman, our chairman, the professor, will agree with me that there is no other home for electrical engineers than SAIE. And there's no other platform which is giving great value to engineers like the SAIE, bringing companies like Old Mutual to give you what you could not have expected to find from an engineering institute. But the team of SAIE management have made it possible. Thank you, Professor. You are a great man. You are a great man. We thank God for having given us you yourself. Thank you.
Thank you, Mishek. Thank you for those wonderful and warm words. Thank you very much, colleagues. Let me take this opportunity to share with you the first round of the business breakfast sessions is planned together with Old Mutual. The first business breakfast will be held on the 7th of August at Council Chambers, SAIE Observatory, SAIE House in Observatory. The second business breakfast is planned for 6th of November. So record those 2 dates. You're most welcome to come and join us for morning breakfast. And again, we would have both the teams, the investment team and also the estate planning team present, and you could take on one-to-one conversations with our colleagues. Thank you very much, and thank you for your time this morning. Thank you, and enjoy the rest of the day. Let me hand back to Minx for your concluding remarks. Over to you, Minx. Thank you.
Thank you, Prof. Naidu, and thank you to Ms. Jooste and Mr. Hasselman, who left us already. But most importantly, this webinar would not have been possible without our attendees. Thank you very much. If just a last comment, if you want to get more information about Old Mutual, scan the QR code on your screen or click on the link that you'll find in the chat box. And hopefully we see the winner. The winner will be announced in the What Now magazine from this webinar. I thank you very much for joining us today, and all have a good day. Goodbye.